If you're a Canadian investor, you've probably noticed a big trend in the Canadian energy sector. We've seen a huge amount of money rushing into Canada. Canadian stocks are at all-time highs. The TSX is killing the S&P 500. Canada is absolutely a destination for investment dollars right now, and energy is a part of that story. But we're seeing energy divide into two categories. We have oil, and then we have gas. Today, I want to talk about Canada's biggest energy company, Canadian Natural Resources, and why I think this is a really good moment to build a position. This is one of those companies that has dramatic long-term potential and that I think really does benefit from a lot of the macro trends we've seen around US shale oil, around Canadian infrastructure investments, and of course, around the long-term demand for energy. So in this video, we're going to talk about what has happened recently splitting Canadian oil from Canadian gas as far as stocks go. We'll talk about the longer-term potential for Canadian Natural Resources. We'll cover some really in-depth analysis about its long-term potential. Finally, I'll talk about why I bought this stock this month. Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk about investing in Canada. If that interests you at all, please do like the video, subscribe to the channel. It makes a massive difference, and it doesn't cost anything. So I'm going to start right here by showing you this chart. So I got a whole bunch of different colored things on the screen, and you'll see in the purple, we have CNQ. That's a ticker symbol for Canadian Natural. In the orange, we have ARC Resources. It is a great Canadian natural gas and condensate play. In the green, we have Tourmaline, TOU. That is the biggest Canadian natural gas company. And in the pink, we have Peyto, which is one of my favorite Canadian natural gas companies and a high flyer over the last year. And of course, this is on a 1-year time frame. And you'll see that these stocks more or less traded together through the start of this chart. So we go through the summer of 24. They might be a few percentage points off from one another, but they more or less trade together. And here in late November, you start to see separation. While Peyto goes up, the others start to dip a little, and clearly we see Canadian Natural getting separated from the pack. As time progresses into 25, that dip gets bigger and bigger and bigger and bigger, with one of the highest points happening right now. As we close out this chart, you see a dramatic difference between the front runner and the last place, with Peyto 45% outperformance over the last year. Now, of course, this is a shorter frame of mind. Most investors don't buy things and hold them for just 1 year. But it's really clear that Canada's natural gas investors have had a huge run in their stocks. And this is part of the overall trend in Canadian natural gas. We've got LNG Canada coming online. We have multiple natural gas projects. Natural gas is held up in price much better. And there are so many short-term catalysts for Canadian natural gas, making them a fantastic investment. And I believe they will continue to outperform throughout 25. But it does bring up the question for Canadian natural investors, for Canadian oil investors. With prices so low, doesn't common sense say you should buy? Well, I think it does. And I think that if you are focused on longer term investment results, right now is actually a great opportunity to buy into Canadian Natural and honestly into most Canadian oil names. So let's talk about some of the reasons why I'm so bullish on Canadian Natural Resources, why I think they have some huge potential, and of course, why I bought this stock this month. If you watch the channel, you'll know I've been diving into the mindset of investors. It's something I'm personally really interested in, and I think it helps us understand why people are buying the stock. And one of the best sources for this that I've used over the last month is Seeking Alpha, because it just allows regular retail investors to publish their articles for the world to see. So this article is from Daniel Milado. I might be mispronouncing that, but he puts together an article titled Canadian Natural Resources with 33 years of reserves and output expansion, is the company undervalued? Came out the end of April, end of last month. So not quite a month old as I published this video. He talks about reserve life, which is something we've talked about on the channel. Very interesting. Talks about their expectations to increase oil and gas production this year. Talks about a conservative DCF model, which shows the overvaluation, while the neutral DCF shows an undervaluation. So it brings up the question of, okay, how do you value this? And then it talks about the dividend yield. We'll go through most of the article. We're not going to dive too deep, but I think it is valuable to see. He brings his investment thesis off the bat. I think that's great. So he rates Canadian Natural Resources with a buy rating. I think the company has several positive aspects that investors should consider when investing in an energy company. Has proven reserves for 33 years. Consequently, the company does not need to expend resources to acquire assets to expand its production for several years. In addition, the firm expects to increase its oil and gas output by 12.44% for this year. Furthermore, the company expanded its production by 3.9% between 2017 and 2024. Should point out, a big part of their growth this year is through acquisition. We talked every time they made an acquisition last year, which was, I think, at least 3 different times. We talked about specific acquisitions of CNQ, but obviously the big ones were them basically consolidating the Athabasca oil fields. They're like the player now. Okay. In this year, CNQ expects a 5.65 EV to EBITDA ratio. In my opinion, this ratio is an appealing value due to the fact that CNQ is the second largest Canadian company by market capitalization in the oil and gas industry. On the other hand, in the last 4 years, CNQ paid on average a 4.56% dividend yield, which is another positive aspect. If you're questioning, hey, why do you say this is the largest oil and gas company if he's saying it's number 2? Obviously, he's talking about Enbridge, which is not an oil and gas producer. They're the midstream giant in the Canadian market. I implemented 2 discounted cash flow models, DCF models, to value CNQ. The conservative model suggests the company presents an overvaluation. Meanwhile, the second model indicates that CNQ experiences an undervaluation of 31.97%. Consequently, there's an upside potential. When pondering all these factors, I consider that CNQ is an excellent investment opportunity. I do want to say right here, as a longer term investor, value investing might not necessarily be the way to go. And I'm not saying that in general, but I am saying that if you are going to hold something for long term, then you shouldn't be looking at picking, at market inefficiency, to use the term, at buying something that is cheaper on the stock market than it would be if you split it up and sort of sold the parts. I think you should be buying something that has potential to grow long term, which is why I'm invested in CNQ. If I had to outline my investment thesis in CNQ, they're the scale player in a market whose assets are clearly showing more value. They have a unique upside opportunity if we see the WCS differential reduced, which I believe it will be in the short and medium term. And of course, they present a huge potential expansion opportunity if they continue to offer dividends, if they continue to grow their free cash flow. They just offer so much opportunity because of the amount of money going through this business every year. And so they could see this share price just dramatically appreciate over the next couple of years. Now, would I hold the stock forever? No. And if you are a longer term investor like me, that is obviously something you have to think about when you're buying a commodity based stock. What do you think the future of that commodity looks like? Now, clearly, I've talked a lot about Canadian oil. I think Canadian oil specifically has a great bullish 5, 10, maybe even 15 years. I'm not necessarily bullish on global oil, but I think the unique factors of the Canadian market make CNQ and other companies like it uniquely valuable. Let's continue through this article. I think the new trade policy implemented by the US has generated mispricing opportunities. I would agree. I talked about this when those sort of policies started. As such, I decided to analyze Canadian Natural Resources, second largest Canadian company measured by market cap in the oil and gas industry. Firm says it's the largest crude oil producer in Canada. Yep. For 2025, CNQ expects that 27% of its production will be natural gas, 26% heavy oil, 11% light oil and NGLs, and 36% SCO. In my opinion, the company exhibits excellent EV to EBITDA and price to cash flow ratios. Again, this is value investing, right? What is the company actually worth? Which is a hugely respectable position to take. If you're a value investor, I have a huge amount of respect for you because it's probably the hardest type of investing. And it is one where you are usually dead set on what a company needs to be for you to buy in. And so if a value investor agrees with a growth investor, you should probably buy the stock. Because when those two different disciplines cross, man, it usually shows unique opportunity. Again, I've been talking about this for a little while, and there's lots and lots of value investors that would agree. Now, Canadian Natural specifically, some value investors argue it's overvalued, right? We saw that in the introduction, mainly because you're paying a premium for the name brand. Think about it, you're at the grocery store. You recognize the name brand, but it's more expensive than whatever the grocery store's own brand, or maybe a discounted brand, or a brand that you just don't recognize, right? Shoppers tend to pay that premium for that name brand because they recognize it, they know it, it's bigger, it's more established, maybe it's more consistent, versus the smaller names, which in this case would be mid or smaller cap companies, might be cheaper, might present the exact same value. And so value investors might say, hey, that's clearly the better buy. But a lot of investors tend towards the name brand. Do you agree with that? Maybe not, but it doesn't change the fact that that name brand is probably still a good deal. Okay, we'll continue through. The proven reserves are another positive aspect. In 2024, the company reported 15.98 billion barrels of oil equivalent proved reserves, representing 33 years of operation at its current production levels. When including proved and probable reserves, company has reserves for 43 years. For instance, in my article about Cortera Energy, I mentioned that CTRA acquired assets for 3,950, so 3.9 billion. CNQ does not need to acquire lands or companies to extract oil and gas for several years. Doesn't mean they haven't been. Let me just say that right now. I know this is written in April, but they have, 2024 was a acquisition spree for them. Some of those acquisitions, one specifically, I believe the last 10% of Athabasca hasn't closed yet, or maybe is closing sometime in the next little bit. I don't remember exactly what the date was, but it should close sometime in 25. Canada has 168 billion barrels of proved reserves, ranking third as the country with the most reserves. Logic is simple. CNQ is the top oil producer in a country rich in oil and gas. As such, it should have a competitive advantage. Company does not have the same competence that a typical oil and gas firm has in the US or Europe. I wonder. I'm hoping that they're saying that they're better, right? They're more competent, but I'm interested. From a financial perspective, CNQ shows solid results. Reported positive net income margins in 6 of the last 7 years, as depicted in the following chart. Negative result was only in 2020. In that year, the world faced a lockdown due to COVID, but I think this scenario is unlikely to occur again. Knock on wood. Let's hope not. Production. CNQ has expanded its oil production consistently for several years. Following chart shows its production has grown by 41.68% since 2017, as depicted in the following chart. For 2025, the company expects to produce 1,532.5 thousand barrels of oil equivalent per day, representing a 12.44% annual increase. Wow. Okay. But I mean, you should be impressed by the amount of BOE equivalent growth. It is pretty huge. Trump. Ooh, I think that writing an article without including a shift in U.S. trade policy would be naive. In 2023, 56.4% of the oil imported by the U.S. came from Canada. Main difference between Canadian and American crude is that Canada has heavy crude, by contrast, U.S. has light crude. Therefore, it is not the same type of petroleum. Consequently, refineries use different tech to process Canadian crude, require immense resources to transfer heavy oil refineries into light oil refineries. Last argument is that the U.S. does not have the reserve levels that Canada has. For instance, 2022, U.S. had proven reserves for 48.3 billion barrels of crude oil. Meanwhile, it produced approximately 4.4 barrels of oil in that year. As such, the reserves last approximately 11 years. Therefore, U.S. might need to import oil in the future. Due to all these factors, I think CNQ will hardly be affected by an eventual trade war between the two North American countries. Definitely think you can see right there the different tone that has been set throughout the end of April into the month of May. Because I think right now, the trade war is probably, it's at the back of our minds as Canadian investors, but we've actually seen just about a month here of like really solid, positive Canadian results. A lot of money flowing into Canada, a lot of investment going into Canadian stocks, not necessarily into the Canadian economy. And I think there is a bit of a split there. And that's like a story for another day. But Canadian stocks have seen quite a positive month. We've seen a lot of people buying into Canadian stocks, buying into our resources specifically. But I could see that maybe there was definitely some fear in April that we've lost. I think it's interesting to reflect on that, right? See how the trend has changed. I think that obviously with something like trade wars, if you're talking about valuing something based on how the trade war is going and what the price looks like on any sort of daily basis, it's such a chicken shoot. Like you're just completely, you're throwing a dart in the dark. You don't know. You have no. Trump could say something tomorrow and completely change the valuation of a company like this. Maybe it's, no more Canadian oil or tariffs on Canadian oil or whatever, and you'd see these stocks crash. Or it'll be no more tariffs on Canada, and maybe you'll see a big rally. Who knows? Conservative valuation. Section implements a DCF model to value CNQ. Implement conservative assumptions to estimate the fair value of the company. My view is better to miss 5 opportunities than to choose 5 wrong ones. Hey, I absolutely respect that. I think that's a really smart way to approach investing. Rule number 1, don't lose money. It's a Charlie Munger quote. Scope to avoid is the scope is to avoid what in statistics is called a false positive. In other words, saying this is a good investment when the reality indicates it's not. Posing restrictive assumptions is a mechanism to reduce this scenario. Okay, oil price. Assume there will be a pessimistic scenario for the oil price. My approach is simple. I hypothesize that oil prices will decline by 10% annually between 2024 and 2029. Whoa. Therefore, in 2029, WTI will decrease to $44.73. I use a probabilistic approach to obtain this number. Between January 4th, 2010 and April 7th, 2025, WTI was or below or equal to 44.3 on 10% of the days as depicted. Whoa. I think just reading that right there, that this thesis is not taking into account the decline in US shale. Anytime you look at a total oil supply chart, the US just exploded onto the scene in the 2010s, which dramatically dropped the price of oil. Because all of a sudden, fracking just unlocked this giant reserve, and that is always possible. Remember, this is a commodity stock. Commodities are always at risk, but specifically having that commodity happen right next door in the US at such a scale was brutal for stocks like CNQ, for all of the Canadian oil producers. And we saw that sort of, 2014, let's say, was probably the zenith, the top, the peak of Canadian oil before US crude just really came online for all that fracking, really did a number to the price of WCS, of Canadian crude. I don't expect that to happen again. Personally, of course, I could be wrong. Great context in 2024, break-even price that oil companies need in the Permian Basin was an average $65 a barrel. In my opinion, a 44.73 per WTI barrel could be the scenario of a hard trade war. Sure. Up to this point, I had simply discussed oil prices. However, I have not forecasted CNQ's production, which is another critical component for projecting the company's revenues. Absolutely right. 2025, CNQ expects a 12.44% increase in production. Use this rate to project its crude oil output for 25 as depicted in the following chart. Meanwhile, assume that the production will increase at a 3.989% compound annual growth rate between 26 and 29. Okay. Growth rate of production after royalties between 2017 and 2024. Smart. I would say that those years represented a lot of acquisitions, and I don't know for sure that will happen in the future. Finally, I add both rates. WTI growth rate plus CNQ's production growth rate. Sum is the expected growth rate for CNQ's revenues, which of course will suck. Basically, will be down, because if the oil price drops so dramatically, if you think about it, all you're doing really in this scenario is you're taking negative 10% and then you're adding 3%. So of course you're gonna have a bad number every year. I'm gonna push back on this just a little bit. I am personally somewhat bullish, specifically on WCS pricing, on the price of Canadian crude, because I believe, like a lot of major Canadian investors, a lot of big names in the space, like guys like Adam Watrous, guys like Eric Nuttall, these guys that are big asset allocators that spend a lot of money in the Canadian oil and gas space, that American shale oil does not last forever, that we are seeing, if not the twilight, we're seeing the peak soon of US shale. And after that, the closest, most investable basin will be the Canadian one. And so a lot of American money will flow into here. We'll see stocks run up before we see prices run up, but we will see prices run up. And you'll see WCS at least come up to, $60, $70 US. That's my belief. That is my macro belief on the price of oil. So of course, I disagree with this conservative estimate, but it's important to think about it. Okay, if that happened, what would the fair value of the stock be? So we'll zoom down a little bit here, because there's a lot of really very valuable math. And you'll see fair value in this scenario is about $32. Stock price was priced at $40 as of writing this article. Interesting. Their neutral DCF model basically says that WTI prices will decline this year, but they will stay flat after that. And of course, you'd see then basically the math changes, as you can see, from down a little bit in this next year and then up a bunch every year, up about 4% every year. And in this equation, using the same math, they find fair value at $53. Okay. I think this is really interesting to see the arguments being made by retail investors. We're gonna jump back here Again, I've pushed back a little bit on this analysis, but I do think it's really valuable. I think it's really interesting to see a different perspective. I've shown a lot of maybe growth investor perspectives on this channel. I've shown a lot of sector specific investors on the channel. Really valuable adding a value investor in there, seeing how somebody breaks down how to understand a company. And of course, if you're a value investor, you probably know all this. You're probably thinking, wow, this guy doesn't do the math like I do. And that would absolutely be true. You're probably light years ahead of me because that's just not my investing style. That's not how I've invested. I am a fan of compounders over time. I like stocks that can change something or offer a unique opportunity. And of course, I'm a fan of investing in trends that I feel I understand, specifically here in Canada. The resource trend has been going strong for the last couple of months. A lot of Canadian resource stocks, like I showed you guys the Payto chart earlier, a lot of Canadian resource stocks are up huge in the last little while, particularly the last 5-6 months that I've been talking about them. Does that trend last forever? Absolutely not. No trend does, but they're up a huge amount. We've even seen bank stocks run in the last month. Canadian banks are a great investment opportunity, long term. So there's all sorts of different things going on in the Canadian market that I think are super valuable. I'm going to end today by talking about my basic bull thesis that allowed me to buy CNQ. And I mentioned a lot of this earlier. Number one, right now they're at a discount. We've seen natural gas stocks run up. We've seen oil stocks drop. I think that offers a simple opportunity for a very simple reason, that you want to buy low and sell high. And right now, with fear up, with worries about the potential of crude oil in Canada, with worries about the potential direction of the new Canadian government, with worries about the overall economic situation, crude oil has been dropping. And so I think there's opportunity. I think this is a low point. I do not think it'll last forever. Of course, I mentioned this earlier. I think WCS will materially outperform other oil prices, other benchmarks in the next 5 years. I think we saw the last 10 years show a brutal battering of the Canadian oil industry. I think we saw a combination of domestic and, of course, American international factors just crush a lot of Canadian companies from a profitability standpoint. And we've seen a lot of those companies have to adapt, become incredibly efficient to survive. And with US shale hitting its zenith, with it declining as the US continues to grow their need for energy, I think there's a huge opportunity. And I think that means that WCS pricing will improve, which then, of course, means that these super efficient Canadian producers, like, of course, name brand CNQ, are going to outperform. Third, I think there's going to be a rush of investment into Canadian energy assets. Now, this can take the form of literally Canadian energy stocks. I think we've seen some of this already with natural gas, but with, that question in the air of US shale declining, there's a lot of money that is sitting in those companies that is looking for a new home. And I think Canada makes a lot of sense from a sort of stability perspective, from a proximity perspective, from a geographic perspective. If you were an American company, it's a lot easier to invest in Canada and get that to your sort of customer base than it might be for you to go find that same oil in Africa or in Asia or in South America. I think that Canada presents an opportunity there. However, of course, we have seen some pushback on that argument based on the idea that Canadian government might not be super helpful for these American companies that want the cheapest, easiest way to get oil. Again, not making a political statement. I'm just saying, if one country is like, yep, we got no regulations, no rules, pollute our environment, we don't care. And another country is like, oh, there's all these rules and we have an industrial carbon tax and we have an emissions cap and so on and so forth. I mean, if you're sort of flipping a coin, you might, if you were a complete, profit driven company, you might go with the option somewhere else. But again, Canada does offer benefits. So I think there's huge chance for a big amount of American money coming in. We've also seen the pricing of those assets change dramatically. We saw the Strathcona Resources MEG deal that sort of, was thrown up in the air, and there's been a lot of chatter in the last little while. I've name dropped Eric Nuttall like a million times on the channel because he's one of the guys that actually sort of is out there in the media talking about Canadian oil. He was not happy with the price offered for Meg Energy. He's like, come on, guys, I love this stock. I think it has great potential long term. It's a great asset. I think it's worth so much more than this. He doesn't want it to be bought out, obviously, at a 9% increase. If he thinks he can make 50, 60, 70%, that's logical, right? But I think there's a real opportunity there. You know, whatever the next offer might be from somebody, right? We might see a bunch of money flowing in. And if you see, okay, well, those assets are now re-rated at this much higher price, right? Be it the 9% or 20, 30%. Well, what are Canadian Natural's assets worth, right? Like if Meg Energy has a huge premium put to it, well, should these guys be a $70 stock, right? If you compare the percentage gain, right? 9% would be something, but 20, 30% on the share price right now, that would be pretty impressive. So you could see that question sort of put up there. And then, of course, there is the sort of last man standing argument. The Canadian resources, Canadian energy is stable. It is safe in a world that's considerably more unstable, where there is conflict all over and there's questions about how things are going to work and there's questions about conflicts. Maybe Canadian energy ends up being last man standing, right? The best available option for a bunch of nations that include, of course, the United States, but also other allies around the world. So there's all these different arguments that I think coalesce into Canadian Natural at a discount being a great buy. So that's why I put extra money into it this month. Now, I am a diversified investor by both a sectoral and a temporal or a time basis. I do not invest all my money all at the same time. So it's not like I just dumped everything and bought this stock. And I would strongly recommend, I am not your financial advisor, but I would strongly recommend against doing that ever. Doesn't matter how great the opportunity is. If you put everything into that, your eggs are all in one basket and you can be wrong. And again, like I mentioned earlier, number one rule, don't lose money. So if you then extrapolate that, the biggest part of that rule is don't lose all your money, because interrupting the compounding growth effect is brutal. So I'm buying a little bit more right now. I'll buy a little bit more in the not so distant future. And I will update you guys on my portfolio later in the month. But thank you for making it all the way through this video. I hope you enjoyed that. It really was like a deep dive, talking not only about my opinions, but trying to share some other opinions here on the channel. And if you have opinions, I would love to see them in the comments down below. Let me know. What do you think about Canadian Natural? Again, like I mentioned, there's a lot of other oil names. I use these guys as sort of the, again, name brand, the most recognizable company here. One of the biggest asset basins, least likely to get bought out, right? They don't have that sort of worry. But there are so many other names. So if you want to mention one of them, you want to sort of state your investment thesis on any of them, I would love to see that in the comments below. And if there's another stock you think I should be talking about, you think it's at a discount, anything in the Canadian, or of course you can go international and we'll talk about them too. Please do drop that down below. And with all that being said, I hope you enjoyed the video and I will see you in the next one.